SoFi reported quarterly financial results on the morning of October 29th, 2024. That has sent the stock price down roughly 10% on the news. I'll review the latest quarterly financial results for you here in this video, and I'll also update my buy recommendation for SoFi stock. I've had this stock rated as a buy all year long, and you're going to want to tune in to see if I'm changing that recommendation following these latest financial results. I'll share with you the key figures that were good for SoFi in the quarter and the figures that could have investors a little bit concerned, and explain why the stock price is down 10%. What are the numbers that are pressuring the stock price lower? So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Right, SoFi is saying that their financial services and tech platform segments now make up a record 49% of SoFi's adjusted net revenue, which was up from around 39% a year ago. This signals continued execution and deliberate shifts toward capital light, higher return on equity, fee-based revenue streams. And that's been the strategy for SoFi's management team over the last several years. Is they want to be less of a bank and more of a financial services and tech platform company. Not unlike the way Tesla is trying to be less like an electric vehicle company and more like an artificial intelligence company. SoFi is undergoing a similar shift. It wants to have investors think of it as a non-bank company, because bank companies, bank stocks trade at lower valuations, whereas financial services and tech platforms trade at higher valuations. The big difference, though, is that SoFi actually generates 49% of its revenue from financial services and tech platforms, and that was up from just 39% a year ago. So SoFi has already made significant tangible progress on this front, and it actually generates 50% of its revenue from these other segments, whereas the other company does not do that. So SoFi has been on a excellent path forward. The other part of this is that they've demonstrated their execution on shifting towards more capital light, higher ROE fee-based revenue streams. And one way they're doing that is, instead of owning all of the loans that they originate, they're selling it off more. In the most recent quarter here, this one, they sold off or originated over $1 billion of personal loans for third parties. And that's a really high profit margin business for SoFi, is just handling the application and the due diligence, originating the loan, and then selling it to a third party, and then generating fees for its services in that process. So that's almost all profit margin, and it eliminates a lot of the risks with owning a loan, right? When you make a loan and you're collecting the payments and you're owning the loan, that means if the borrower defaults, you're the one that loses the money. But when you sell it to an investor, you're not the one that loses the money anymore if the borrower defaults. So you lower the risk, but you still generate the fees from originating the loan. And so that is a more capital light and higher return on equity revenue stream. And SoFi has made good progress on that category. Overall, adjusted net revenue increased by 30% from the same quarter last year, and this is for the 3 months that ended September 30th, 2024. Adjusted net revenue 689 million, up from 530 million, and then adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, jumped by 90% to 186.2 million. This company is profitable on the bottom line, generating 60 million in net income, where in the same quarter last year it was a loss of 19.5 million. So I talked a little bit about the loan platform business, and in the most recent quarter, the company drove a record sale of more than $1 billion of personal loans that it generated on behalf of third parties. So these are other lenders that want to be in the lending business, that want to own loans, because they generate a good return on investment, right? If you're investing in personal loans, you're going to generate more than 10% in interest income annually. Of course, you're going to take the risk of default, but the interest rates on these personal loans are pretty high compared to what you can get, let's say, in a government bond, more than double the rates you can get with the government bond. So lenders have shown an increasing appetite for these lately, and SoFi is capitalizing on that by originating more of these loans and selling it to lenders that are now not as scared about a recession. Personal loans are the loans that perform the worst during a recession because there isn't any collateral to back it up in most cases. And so when there are defaults, when people lose their jobs, personal loans are the ones they default on first. But if the economy is humming along and people keep making more and more money, they're not going to have a reason to default on these loans. And so lenders are now more interested in these. And we saw big deals in the latest quarter. SoFi signed a $2 billion agreement for third parties buying its loans. The other competitor in this space, Upstart, also signed a $2 billion deal selling personal loans. So investors are showing more interest in this category, and that's great news for SoFi and SoFi stock investors. One thing that was disappointing in the quarter was home loans. The company did not generate as much growth in home loans as I was hoping for, and it could be because the home market or the single family home market is weak in the United States. I think sales so far year to date in 2024 are the lowest on record, going all the way back to 1995 when the population was much smaller. Higher interest rates, lower inventory, and ridiculously high prices. I can't think of very many categories that are more overvalued than US homes. Maybe in other parts of the world, home values are also overvalued, but in the United States here, homes are ridiculously overvalued, regardless of the metric you look at, whether you look at personal income to the percentage of personal income that goes towards home payments, or whether you look at the value increase over the last 5 years compared to the increase in all other asset classes. Regardless, nearly every metric I look at shows home values as being overpriced. And so you have a bit of a stalemate in the market, not very many purchases being made. And so that's perhaps pressuring the home loan business for SoFi. But still, home purchase and refinancing grew 23% from the previous quarter, while home equity loan volume grew 44% from the prior year period. But when I look at the balance of personal loans versus home loans on SoFi's total total loan origination, personal loans still consisted of a very large percentage of the company's overall loan portfolio. And then a really great bit of information for SoFi investors was the on balance sheet 90-day personal loan delinquency rate decreased to 57 basis points from 64 basis points in the prior loan quarter, while personal loan annualized charge off rates decreased to 3.52% from 3.84%. Now, why is this so important? Well, this is the default rates of people that SoFi has lent money to. And if people that SoFi lent money to are defaulting less, that means SoFi is getting more of the money of the loans that it made. And it signals that these loans are going to perform better than expected, especially coming into 2024. SoFi's management was cautious on the lending portfolio because of the potential for a recession. And now it seems to be going in the opposite direction. The economy overall is humming along just fine in the US. Unemployment is low. Job income growth is solid. Inflation is falling. And that points to great credit performance. And you're seeing that data here with SoFi. This is the number I was most concerned with about SoFi coming into 2024. But it looks like this year, much better than expected for SoFi. So overall, given the puts and takes, it's driven SoFi's stock price down by roughly 10% following the earnings release. Now, I didn't see many numbers that were so bad as to justify a 10% decrease. And one of the explainers as to why the stock price is down is because of the big run up coming into the quarter. You can see the stock price from September to this earnings release had increased from about $7 a share all the way up to $11 per share. So more than 50% increase in about a month and a half. So coming into the quarter, there had been so much enthusiasm already. And then when the earnings came out, they were really good, but maybe not as good as everyone was expecting. There was a couple of um, sour spots, but for the most part, the report was solid. And so now SoFi is trading at a forward price to earnings of 44.69 following this decrease. So to update my recommendation on SoFi stock, do I still think it's a buy? And the answer is yes. I updated this recommendation this morning, highlighting that I still think SoFi stock is a buy. So investors that were interested in buying on the dip, I think it's a good idea. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.